Good morning. Welcome to Stock Market Today. It is Wednesday, February 3rd, 2021. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for that free email where I get a lot of the great content for this show. We also give you daily stock ideas to consider. They hit your inbox every trading day before the market opens. Let's dig into it. U.S. equities closed higher on Tuesday, second day in a row, following through from that rally on Monday. Financials, industrials, and consumer discretionary were each up more than 2%. Healthcare, REITs, and comm staples were relative underperformers, though still closed higher on the day. Treasuries were mostly weaker. The dollar was bid on the major crosses. Gold finished down 1.6%. Silver down 10.3%. Remember, that was the next one that the Reddit raiders were going to squeeze. Didn't pan out. WTI crude up 2.3%, hitting its best level since January of last year. Those of you who have been reading my notes, I've been bullish crude since the breakout through $42, arguing for $60 to the upside. S&P futures this morning are up 40 basis points, so good start, third day in a row. That's after Asian equities were mostly higher overnight, Japan and South Korea leading, although China did end lower on the day. European markets are extending their gains. Treasuries are weaker across the curve. And the curve is bear steepening. The dollar is firmer against the major crosses again. Gold is up 10 bips, silver up 1.3% after falling more than 10% yesterday. WTI crude is up 60 basis points to kick us off on a Wednesday morning where we saw some follow through yesterday, and futures are bid today. Look at the Qs. Qs on the verge of a closing high. Take a look at the middle chart there. Take a look at IWM on the verge of a closing high. Take a look at SPY. We're right there, spitting distance. That's a technical term. It's in the CMT books. No, I'm kidding. But you get my point. All the fear mongering late last week and over the weekend, if you were on social media over the weekend paying attention, the fear mongering was like on level 8 out of 10. It was quite fascinating. And maybe there's something to it. Maybe there isn't, but that's why there's risk management. The trend is up, folks. You can't argue with it. You may think market's heading lower. You may be right. But until these key levels are broken, the trend's up. And if the trend is up, and if you think the trend is going down, that makes you wrong. And if you don't admit you're wrong and change your view, well, you have no process. It's pretty simple, isn't it? The trend is up until proven otherwise. Take a look at the SPY 360, 370 range, and then 340. These are all the same. I'm not going to go through the numbers. You know them. They're here. They're here every day. It's the trends. You can make yourself crazy trading or investing according to what you think should be, or you could just trade and invest according to what is. The trend is up. It's up until proven otherwise. What proves otherwise? The roadmap that I give you here every single day. Let's take a look at our market in a minute now. What are we writing about in our note? Stocks follow through to the upside. And what's interesting here within the context of Chaikin Analytics is the major ETFs are at or near oversold levels. So we're rebounding, and we are still closer to oversold. Remember, for 2 weeks, I've been saying we're overbought. Be patient. We're overbought. Be patient. What do we get? A quick hit last week. They took about 3% out of the market last week. Now we get close to oversold. You had some big hedge funds having to take down their gross, presented opportunities. I titled 2 notes this week along the lines of, this de-risking presents opportunity. You can see it in the bullish sentiment, moderates as those funds de-risked. Move further out on the risk curve in fixed income. That's important. So we want to take a look at that. Pay attention to what's happening there. We want to move further out on the risk curve in fixed income, and futures point to a higher open here today. Now, major indices from a power bar perspective. Let's take a look at the Dow, up 1.5% yesterday. S&P 1.3, NAS, everything kind of in line. No one really stands out. clear outperformer. I mean, obviously at the sector level, there's dispersion. You can see the fins up 2.5% yesterday, 42-3 on the fins for the power bar ratio. Banks worked off that overbought condition. There's some opportunities out there. We looked at the capital markets names earlier this week. So take a look. There's some opportunity out there. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bullish. Stock of the day. Speaking of opportunities out there, Dick's Sporting Goods. DKS is the ticker symbol here. Closed at 70.06 yesterday, up 2%. Very bullish rating. Strong trend, strong industry group. I like this setup here. We had a nice run. We have a consolidation, breakout. Okay. Breakout. Consolidate again. Oversold. Indicator beginning to turn up. Solidly bullish money flow. Recently a personality change. So what do we have? A very bullish stock outperforming is oversold with bullish money flow as it trades within the context of an uptrend. It doesn't have to be any more complex than that. A lot of people like to come at you. Fancy indicators, charts all marked up. It's worthless. Price, relative strength, where are we within the trend? Time and again. And then from there, you manage risk, whatever that means for you. I think as long as, if you're a breakout / pattern person, if we're above 60, you're okay with Dicks. You could use stop levels. You could use average true range like I do to manage your risk. There's a lot to do, but that's a pretty compelling setup. Take a look at Dicks. Let's look at our sector tracker now. Moving to the major sectors over the last 5 days. REITs, fins, industrials are higher. Tech, it's right there. Wouldn't be surprised to see comms move higher today with that Google print. Google trading up about 7% pre-market. It's kind of a mixed bag. A lot of moving parts. Rotation continues to be the lifeblood of markets. We love seeing staples at the bottom of the list. I think energy is set up. I wrote about it yesterday. I think energy is set up for potential here. Had a nice run, consolidated, pull back, set up. Take a look there, maybe. We'd love to see the defensive groups continue to lag, but just a lot going on under the surface of the market. For all the, that one slide where I show and the levels haven't changed for weeks now. Ton of activity under the surface, which is really where you get paid anyway, right? I mean, you can invest in SPY, but if you're just going to invest in SPY, you don't need to watch shows like this or read the work of, people like me and other smart people out there. You just put your money in SPY and do something else with your time. Presumably, you're looking for opportunities to do better than the overall market. And that comes under the surface. That comes with the type of work that we're doing here every day. Taking a look at our industry in focus now, Dow Jones REIT Services, past 6 months, been a laggard. Down 6% relative. Weak ratio, 10-8 bulls to bears. 20 out of 21 subsectors. Realty Income, Matt Cali, and Getty, all very bearish, but a subtle shift taking place here. You can see, look, 12 months of underperformance, right? There was no need to own REITs. And what's interesting to me is that underperformance was entrenched prior to COVID, right? Everybody kind of sold off the REITs, the mall REITs, the healthcare REITs with COVID. But our argument, and if you kind of look at markets the way I do, you shouldn't have been there to begin with. You shouldn't have been there to begin with. They were lagging already. They were lagging heading into COVID. And they continued to lag throughout. Something changing? Maybe. This is the best relative strength we've seen in 12 months. That catches my attention. Pay attention to it, right? We talk about these rotations that are playing out. Not sure what's driving it. Maybe it's a function of rates. Maybe it's a function of rates. We talk, fixed income investors, interest rates in the treasury market, extremely low, depressed, staying low. Chairman Powell told you they're going to be lower for longer. People need yield. Maybe they're coming out on the risk spectrum. We'll look at that a little bit later on. Let's look at what's trending now. Yesterday's movers and shakers are gainers and losers. Waters up 8.3% following their earnings. Expedia was upgraded on the first at Wedbush. I think Expedia is one of those names that was widely owned by some of these hedge funds that were taking down gross. So stock got hit and presented opportunities. LVS didn't see anything company specific there to drive trading. Retail was positive in general yesterday. And L Brands went along for the ride there, up 5.38%. KMX up 5.25%. Nothing company specific there. Loser side of the board, Vertex reported that stock down 6%. DaVita, no news, down 6%. I think one of their peers was hit pretty hard, so maybe DaVita was down in sympathy. Disca, nothing company specific there. That stock down nearly 5%. Did catch a downgrade at Citi, but that was back on the first, so maybe some follow through. Not sure. We mentioned the Dow DuPont IFF deals, buying businesses. That stock down 4.5%. FOXA, nothing company specific to drive trading in that name. Let's look. Bullish sentiment moderates a bit, which makes sense. There's been de-risking going on in the market, especially at some of the bigger hedge fund level. So the 13-day moving average of the CBOE put call ratio. I mean, listen, you have to squint to see it, right? But that line did tick up. And you can see the VIX spiked as well. Look at the VIX last week, big spike from just over 20 to over 35, and then right back down. Right now, it's that. So we still have that interesting dynamic where options traders, we know what's going on, right? Retail options traders are flooding the market for calls, right? YOLO, right? YOLO calls on bankrupt companies. Okay, whatever. It's a strategy. I'm not saying it's a good strategy. I'm saying it's a strategy. But that's persisted. This is not new. It's been in place for a while now. It's been in place since May, June. We've talked about it. Remember last week I joked that I'm thinking about getting rid of this chart. As soon as I get rid of this chart, the picture will change. So I'm not going to do it. But it's an interesting dynamic that's playing out within the marketplace. It's something that we need to be aware of. Especially if you're looking at thinner names that captivate the masses, you can see some outsized moves because of options positioning and options trading and hedging that goes along with it. The fact that the VIX is stayed above 20 is compelling. Obviously, we have a volatility regime shift caused by COVID, right? I think how long it lasts, who knows? But you had a low vol regime for a long time where you had intermittent spikes up to 30, but generally we're in the teens for the most part. Then we had COVID, and now we pull back and we've kind of based out in the 20s. So that's kind of interesting to me. That's a regime shift within volatility. So we talked a little bit about what I think could be happening in REITs. I think it's income. I really do. And I think investors within fixed income are moving out on the curve, right? So BIZD is kind of interesting. It's a BDC income ETF. This thing yields 10%. All right. So in a world where treasuries, the 10-year treasury yields 1%. I think investors are making the assessment that, like, hey, I'm willing to take on a little more risk, or a lot more risk in some cases. You never know until you do the work, but I'm willing to take on more risk to get that yield. And take a look at this BIZD above the 50-day, above the 200-day RSI and bullish ranges, actually outperforming. Look at the scooter at a 10% yield. If that's your cup of tea, if that's what you're looking for, you might want to take a look at this and do some more work on it. I think it's interesting. I think it speaks to something that I've been writing about and talking about for a while, which is just again these investors moving further out on the risk curve within fixed income. We'll see how that plays out, but it appears there's just not enough yield in treasuries, especially with inflation picking up. And then finally, I'll leave you with Guru, Guro. This is the Global X Guru Index, which seeks to generate alpha over the broad market by investing in the highest conviction ideas from a select pool of hedge funds. Now, remember, we had everybody, a big degrossing around the street late last week. That means cover your shorts and sell your longs. So to me, I want to go through the holdings of a fund like Guru and look for potential opportunities. I'm not saying you have to look at the fund itself. Use it for idea generation is how I'm thinking about it. So might be an interesting way to come at markets. That's going to wrap us up for today. Take us for that test drive. I'm back tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.